We turn our attention to African Bank Investment Limited now, and Viv, we'll start with you. In particular, the full-year earnings for the September 2011 year-end, 24% rise, which was below analyst expectations, expecting 27%. Now, why were these expectations lofty? Were they justified?
Look, I mean, even with the low expectations, the P ratio is still quite attractive. It's better than the other two banks we'd be talking about. It's significantly lower than Capitec, and it's even lower than Standard Bank. So even with, like, first mention of the fact that even with the lower earnings we've seen here, they are still giving you a rather good P ratio, and 4 Ps are going to bring them to a P ratio possibly below 10. So we're looking at a very attractive bank in terms of the P ratio that's been pushing through. Some of the things that have been difficult with the bank are obviously in terms of like everything that we're seeing out there in the market at the moment. You know, every bank is experiencing some difficulty with regards to loan acquisitions, etc. Capitec also, Abil is also, you know, in the process of actually trying to expand its branches out there. It has that Ellerines business that it's acquired previously, and it's trying to use that in terms of actually getting itself a greater presence in areas that it doesn't actually have at the moment. So effectively, by acquiring the Ellerines, not only it's acquired the furniture business, it acquires these multiple branches out in the country, and it's trying to expand into the different areas and trying to actually get into a more, you know, interpersonal kind of relationship with the customers it's seeing out there at the moment.
We'll come back to the Ellerines relationship a little bit later. Let's cross to Johny now in Cape Town. Abil has got a market share of nearly 40% of the total unsecured lending market, and the strong growth in lending is justifying fears that perhaps Abil could be headed for a debt trap. What's your comment on that?
Sorry, I don't understand the question in terms of a sort of a debt trap. I mean, they are the biggest player in the micro lending space, but they have a massively well-funded sort of bond program through which they raise the capital to advance to their customers.
And so you don't think that they're headed for a debt trap then, in short?
No.
Not at all. Okay. Viv, let's come back to you now and touch on the relationship with Ellerines. The incorporation of the credit book has now been successfully completed. Remember that acquisition happened in 2008 for 9.1 billion rand. I want to get your sense on the strategic focus on the relationship between Ellerines Holdings and Abil. The banking business grew its headline earnings by 24% to 2.3 billion, whereas the retail business headline earnings were 190 million rand. Ellerines generating a return on equity of 6.9%, up from 4.8% in 2010. What is your take on the strategic relationship?
Look, I think it's quite interesting to look at just how they're approaching it. For instance, look at F&B. F&B's approach is to have, you know, fewer branches out there, have more an online presence with these customers. You know, more the customer comes online, does its thing through the mobile app, and that's why they have all those, you know, cheaper phones, etc. out there. But Ellerines has taken a different approach. It wants to have a more interpersonal relationship with these customers, wants to have these multiple branches out there via Ellerines and have that kind of relationship with customers. Obviously, you are going to have an experience in which customers are going to be looking at, you know, a different kind of customer base. You know, the most tech-savvy might go with someone like F&B. Someone that is not so tech-savvy might be more comfortable with a company like Abil, you know, going and having the ability to actually have a branch in his vicinity to actually deal with it. Going forward, I don't know if the strategy is going to be successful in the long run. I don't think a bank needs as many branches as Abil is going to be, you know, effectively getting through its Ellerines, you know, business out there. So I don't know if that's a longer-term strategy that's going to be successful. In the short run, it may actually be good for them in terms of getting new customers coming through, however.
Johny, let's come to you in Cape Town and get your sense on the dividend. The fact that the dividend was actually flat between 2009 and 2010 at R1.85 and actually coming down from its 2008 level of R2.10. What is on the horizon in terms of Abil's dividend?
Well, I think they were even at 225 in FY07 prior to doing the Ellerines deal. I mean, I think even the sort of most ardent African bank supporter will argue that they, you know, will admit that they overpaid for Ellerines. And I think at the time of the Ellerines transaction, one of the perceived benefits was that they were to be able to take capital out of Ellerines and that we would see some kind of special distribution out of African Bank. Those sort of hopes have faded. With the fact that Ellerines obviously didn't do well through the downturn, and more recently they've had quite a lot of banking growth out of African Bank itself, and obviously need the capital to fund that. This year they're looking to increase the dividend cover from about 1.6 to 1.9, so I think you'll have very good earnings growth out of African Bank, probably as high as 30%. The dividend will grow slightly less, probably around 20%, but hopefully we will start to see some dividend growth from African Bank in the current year.
Staying with you, Johny, in Cape Town, the share price ended 2011 at R34.50, which was 12.7% lower than in 2010, and they're currently trading below their 12-month high of R39.99, closing at 36, just over 36 Rand today. How do you feel about the Abil share price and what the horizon is like for that?
It's looking slightly more attractive than it did this time last year. I mean, if you pull up a graph of Abil, you'll see they sort of spiked at around 41, 42 Rand in January last year, and that's why the sort of annual return doesn't look that great over the last 12 months. It is looking slightly more attractive. Like I said, I think you'll have very good earnings growth coming out of African Bank in the current year. I think finally they'll get some traction on Ellerines, and as your guest in Joburg said, increasing their footprint. It's taken them sort of almost 4 years, but I think they're finally there now. But ultimately we are still concerned about the unsecured lending space, and at this stage the price isn't cheap enough for us.
I guess you're leaning towards not hot then for Abil, Johny.
Yeah, not hot for us, thanks.
Not hot for Johny. Viv, how do you feel about the share? Johny obviously mentioning the fact that unsecured lending is quite risky, but the demand for credit remains high amongst informally employed people, and that is Abil's target market, but the variability of income of the low income market is also quite a challenge. How do you feel, and what's your take on the share?
As I mentioned earlier, the P ratio is very attractive. The earnings are quite strong, etc. But the risks, I think, overwhelm the actual attractiveness of the earnings out there. We are seeing a company that's basically in a market that's going to be very sensitive to any kind of downturn, any kind of volatility in the global economy. And I do think we are going to see that going forward. And if that is the case, their customers are going to be under extreme amount of pressure. And for the kind of customers that Abil has at the moment here, I don't think the risk that you're going to be incurring by having Abil in your book is going to justify the kind of return you're going to be getting from the company.
So it sounds like it's definitely not a hot for you either.
Well,
something that is hot is your stock pick, and you've gone for Foschini. Now, we had a retail theme yesterday where we covered Foschini. Tell us why you think the share's so hot.
Look, when it comes to retail, to a large extent, it's not just about the kind of business case for the company. It's also in terms of the style taste, let us say, or the style case for it. And apparently, Foschini, as you can see, I'm not exactly the most fashionable person in the world, but the research analyst at our company assures me that Foschini has done extremely well in the last year or so, in terms of actually getting the mix of merchandise correct, and certain female colleagues in the office have concurred with that. They think that Foschini has done really well with that, and you've seen that, for instance, outperforming Truworths over the last few years in terms of both same-store sales, in terms of the growth the company is experiencing. It's from a very high base. It's managed to have very good sales growth of the last year, and one of the reasons they're picking it. I think the company is done really well, and it's going to do much better than, for instance, like I mentioned, Truworths and Woolworths going forward, just because of the kind of mix it has in terms of productivity, as well as the kind of sales it has in that. In terms of the same store sales it has incurred as well.
I wanted to get your take on the potential competition from more international players. Obviously, Spanish Zara is in the country. They are planning to open up another store in Durban. What will be Foschini's response, and what will be some of their growth drivers to counter the effect of more foreign players playing on their turf? Yeah,
I mean, look, they are obviously going to be affected by a player like Walmart. That's just just too low for them. However, as you mentioned, there are some higher level players entering the market. But Foschini, for instance, if you look at the new store that they have in Sandton City, has got quite a good mix at the moment, has quite a good retail presence, a retail just let us say atmosphere at the moment, and I don't think they're going to be suffering too much from a new company coming into the country.
And what about inflation? We saw their store inflation sitting at around 6%, if I'm not mistaken, and obviously inflation is something that's good for retailers because they just pass on higher prices to their customers, and obviously that generates more sales for them. Are you concerned about where the in-store inflation is sitting for Foschini?
Look, they are at 6%, but they are better than Truworths, they're better than Woolies. I think the only one that beats them reasonably is Mr. Price. I don't think a person that's going to buy an item from Mr. Price is looking to buy the similar kind of item from Foschini. Even though they may shop at both stores, they will not shop at both stores for the same kind of item. So even though the Mr. Price does beat them in terms of the inflation, as you mentioned, and price increases, I do think that Foschini, compared to the stores that will actually be competing with, the Woolies and the Truworths out there, has managed to keep its price inflation lower.
Still your hot stock pick. Thank you, Viv. Let's go to Johny now in Cape Town. We started the show with Standard Bank, and this is your stock pick. Tell us why this is hot for you.
I think Standard Bank's sort of a slow burn recovery story. As I mentioned earlier, I think they are in the process now of sort of taking out some costs out of the system, and also looking at redeploying capital, which sits fairly idle, both in their London branch as well as in other parts in Africa. So at the moment, if you look at the ROE on historic numbers, it looks quite pitiful, sort of barely covering their cost of capital. But like I said, on a 2 or 3 year view, if they can get higher returns on that capital by either redeploying it back into South Africa and perhaps passing some of that back to shareholders, you should see the ROE climb quite nicely. Stock at the moment is trading at about 1.7 times NAV. It has been lower, but I think with a recovery in ROE, it's fairly priced and would be hot for us.
Johny, would you like to give us a quick closing comment on Viv's stock pick, which was Foschini?
Look, I think generally the retailers have done very well. I think in the last, come the beginning of January every year, everyone has said rather pick the banks over the retailers. In the last 3 years, you've been proved wrong. But I think I'd go out on a limb and say that this year will be slightly different. I think the retailers are very much sort of fully priced, both relative to the SA market and relative to their global peers. I think people also underestimate the impact of new entrants, as you mentioned, into this market. If the pie is growing, then Zara coming into the country is not an issue. If the pie is stagnant or contracting, I think the retailers will feel that on the top line. So I find it difficult to find any value in any of the retailers at the moment.